Welcome back. You're watching The Money Show on ET Now. Well, we are continuing our conversation on the budget and the impact it has on your personal finances. And the one asset that we saw a lot of volatility in post the budget, of course, apart from the massive rally in equities, was yields. We did see a sharp spike in, yields, especially after FM Sitharaman announced her borrowings number. It sort of surprised the money market in more ways than one. So what does this mean, for debt funds as a category, as a whole, for different duration of debt funds and more? We decided to delve into this bit a bit in our Meteor Fund Manager segment for this week with Abhishek Bisen, EVP and Fund Manager for Fixed Income with Kotak Mahindra AMC. Abhishek, thank you so much for joining us today on ET Now. So Abhishek, to start with, what did you make of FM Sitharaman's announcements? Largely when we talk about what are the parts of the budget that I as a debt fund holder should watch out for, it's the fiscal deficit number, it's the borrowing number. Fiscal deficit was larger than expected. Borrowing number as well was larger than expected. As a debt fund holder, how should I be reading into this?
Yeah. Hi, very good evening to everyone. Basically, if I have to rate the budget overall in terms of growth story, it is a reasonably good budget. And it has brought a lot of transparency in terms of accounting, etc., of various aspects in terms of subsidy, below the line items and above the line item, and so on and so forth. So from overall perspective, that is a good step. One shot, lot of thing has been done in terms of transparency. Now, how does it impact the fixed income market? As you rightly said, fixed income market was not expecting this kind of large borrowing for the next year. But the problem occurred when they said that this year also they are reasonably short of funds and they would be borrowing 80,000 crore extra via dated securities. So, which means the supply of bond suddenly increased, which was already oversupplied in terms of supply of bonds. So across the curve, there was an impact. So how the government looks at in terms of the overall deficit, they look at in terms of deficit in terms of only cash flows. For example, the government can say the market is flush with liquidity. We have 8 to 9 lakh crore worth of liquidity and we want to borrow, so there should not be a problem. But the problem occurs when they are borrowing on an average 10 to 15-year bucket. But the liquidity probably will remain to this tune for, let's say, 3 months, 6 months down the line, or maybe 9 months down the line, the liquidity is going to vanish. And therefore, what typically happens, the curve becomes steeper. So if you observe 3 month, 6 month rates are just 5-10 basis point here and there. So liquid or ultra short-term funds are not at that much amount of risk, because in 3 months down the line, you will be having a natural rollover. In terms of whenever the rates go higher, you are able to redeploy at a higher rate. But the problem is where short-term category and medium-term or long-term funds, suddenly this kind of supply increases, the market gave up and the bond yield shot up significantly. The benchmark 10-year bond yield, which was trading at 595, suddenly shot up to around 605, 608, and in subsequent sessions, we saw it's above 610 as well. So typically, a rise in bond yield eventually leads to price fall, and therefore we saw a significant amount of negative returns across the bond funds. But at the same time, here, what the problem? One more thing was the yield curve was very, very steep. So across the yield curve, we saw similar price movement. For example, 5-year bond also fell similarly as the 10-year, because the 5-year bond yields were much lower than the 10-year. So the somewhat we called flattening of the yield curve in bear terms, which effectively means the 5-year yield went up much more higher than the 10-year bond yield.
So how would that impact different duration of debt fund holders? You have a long duration fund, you have medium duration, short duration. Like you're saying, the 5-year yield went up as much as or more than the 10-year yield. What does it mean? Because, in 2020, what we saw is that long duration funds especially did extremely well. So what do you think will happen in 2021?
What I essentially meant is we had a fairly good amount of rally across the yield curve in 2020, which was somewhat unexpected. We were not prepared for this kind of rally. So the returns were made disproportionately out of capital gains. Okay. So the short-term funds also gave return as good as or probably higher than the long-term funds because of the yield movement. Now, this yield movement is somewhat reversing, and therefore your short-term funds are getting impacted equally as the long-term funds. Now, going ahead in this year, what is going to happen? Like as I said, the yield curve is very steep. In terms of yield curve, is looking something like this. Okay, this is the long-term yield, and this is the short-term yield. Now, in the short-term yield, you are not getting the higher YTM. The YTMs are fairly low. So your run rate is very low. And for as the long-term funds are concerned, the yields are reasonably high. So this is compensating for the risk you are taking, while the short-term fund, short-term yield is not compensating to the tune which it should to the risk what is it is there inbuilt into the yield curve. Therefore, on a risk-adjusted basis, what we believe is on purely fundamental, the long-term yield curve is reasonably well placed, and the short-term yield curve has slightly amount of higher risk towards the rewards. So if you are willing to take some amount of risk, you should evenly position towards somewhat in the longer end funds and some in the extreme shorter end funds. Like for example, 1 year and the 10-year will make much better sense rather than investing into the 3 or 4 or 5 year category or mid category funds.
Okay, all right. I wanted to actually ask you a question directly on a fund that you manage, and that's the Kotak bond fund. So Abhishek, you know, there was one more announcement, and that's with respect to how the government now will come into the market to borrow money, you know, in the next couple of months, etc. Plus, like we said, that borrowing number as well is high. What can your unit holders, what can the Kotak bond fund holders expect? And also, if you could just tell us a bit about the fund, what category of investors you think it's suitable for? Who do you think should invest in the Kotak bond fund?
Yeah. So, see, we have various funds available across the spectrum. So since we are specifically discussing about the bond fund, let me just tell you that the bond fund has the flexibility to move across the yield spectrum. What I mean to say by that is bond fund typically has a mandate to invest in duration ranging from 4 to 7. So on the higher side, it is capped to 7, and the lower side, it is capped to 4. But on a conservative basis, I can go up to 2 years. So I can actually play across the yield curve. As I gave the example that the curve is very steep, and I prefer a long end of the curve. Therefore, in this fund, I can actually go towards extreme long and manage the overall duration maximum at 7 by a strategy somewhat we call in technical parlance a barbell strategy. So what I have done so far is I have managed the duration in a fashion where the duration appears to be high, but I have managed to reduce the risk by using overnight index swaps and floating rate assets, because of which this typical flattening movement has been captured, and the returns which probably could have been evaporated because of sharp uptick in the yields has not happened. And therefore, the investors have got much better experience in a duration fund, which probably a typical mindset is whenever the yields are expected to rise, typically investors go towards mid or shorter end of the curve, which probably can be much more riskier than being on the longer end.
Abhishek, we leave it at that. Thank you so much for joining us today on ET Now. And we'll take a very short break right here on the show. We'll be back with our Spend with TMS segment. We'll be talking about budget and the real estate space, what it got for home buyers. Don't go anywhere.